the best. It's all about discipline.
How are we going to discipline ourselves so that we're able to save, so that we're able to make good financial decisions?
Recognizing that there's a road ahead if you manage the road in front of you.
The decisions that you're going to be making today in your lives where it comes to money will affect you in the future.
Discipline is one of the things that we often learn, sometimes by our environment, or sometimes we're forced to do it, and sometimes we don't learn it at all.
Stores want to get us in and out and get our money, and that's it. It's a game, so you have to be really wise to the game.
Do you know what it costs to run your home on a monthly basis?
Land acknowledgement. As we gather together, we acknowledge the sacred land on which we reside. It has been a site of human activity for 15,000 years. This land is the territory of the Huron-Wendat and Petun First Nations, the Seneca, and most recently, the Mississaugas of the Credit River. The territory was the subject of Dish with One Spoon Wampum Belt Covenant, an agreement between the Iroquois Confederacy and Confederacy of the Ojibwe and allied nations to peaceably share and care for the resources around the Great Lakes. Today, this gathering place is still the home of many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in the community on this territory. We are also mindful of broken covenants and the need to strive to make right with all our relations. Last but certainly not least, we acknowledge the people of African descent who were brought here against their own will or in search of a safe place to live their lives and raise their children. Reconnaissance des terres. En nous rassemblant, nous reconnaissons la terre sacrée sur laquelle nous résidons. C'est un site d'activité humaine depuis 15 000 ans. Cette terre est le territoire des Premières Nations Huron-Wendat et Petun, les Scéniques et plus récemment les Mississaugas de la rivière Crédit. Le territoire était sujet de l'alliance de la ceinture Wampum plat avec cuillère, un accord entre la Confédération Iroquois et Confédération des Ojibwe et des nations alliées à partager et à prendre soin pacifiquement pour les ressources autour des Grands Lacs. Aujourd'hui, ce lieu de rassemblement est toujours le foyer de nombreux peuples autochtones de toute l'île de la Tortue et nous sommes reconnaissants d'avoir la possibilité de travailler dans la communauté sur ce territoire. Nous sommes également conscients des alliances brisées et de la nécessité de nous efforcer de guérir toutes nos relations. Dernier point, mais non le moindre, nous remercions les personnes d'ascendance africaine qui ont été amenées ici contre leur volonté ou à la recherche d'un endroit sûr où vivre leur vie et élever leurs enfants.
This webinar provides illustrative information with respect to the subject matter covered and does not represent an official opinion or position of the Black Business and Professional Association. The BBPA makes no representations, warranties, or guarantees as to assume no responsibility for the content or application of the material contained herein, and especially disclaim all liability for any damages arising out of the use or reference to or lines on such material.
Good morning, and I hope everyone is doing incredibly today. All right. My name is Lincoln Alexander Estridge. I am a U of T alumni and award-winning social impactivist, the founder of the Fight Inside Society, a speaker and a host, but most importantly, I am honored to be here with you guys today. I'd like to introduce our speaker for this week's workshop, Beverly Allen. All right. Beverly Allen has been passionate about business and investing since her teenage years. At 19 years old, her first job was an insurance company, Jamaica Mutual Life, as typist and then a branch administration. I just want, if you guys can quickly do a little activity for me and find the Jamaica flag in the emojis and post that for me, because anyways, as typist and then a branch administration, she became an insurance advisor in 1986, an investment advisor in 1988. Her financial services career in Canada spans 33 years with Desjardins DFS SIN or DFSIN. Today, we're diving into the benefits and how-tos of building wealth with a tax-free savings account. All right, before I ask Beverly to come on, I just want to go over some housekeeping rules. You will be on mute, but if you have any questions, you can either raise your hand so that I can unmute you to ask your question, or you can write your questions in the chat and I can ask them on your behalf. All right, with housekeeping out of the way, please join me in welcoming Beverly Allen.
Good morning. It is my pleasure to be here. I am grateful for the opportunity to serve. And the financial literacy and financial education, it's ongoing from one generation to the next. Because when I got my license first and got started, we were going to conquer the world and everybody would be rich. And it didn't take long before I realized that it's not going to work like that. And in as much as we have advanced as a society, and in as much as there is so much information available easily on the internet, taking that information and condensing it down into something that you can apply to your own life, that's a whole different ballgame. And that's where the need for a trusted advisor comes in. Okay, so this morning I don't have slides. I'm just going to go through an overview. I've posted the link from the CRA in the chat. So for those who are studious and want to read, you know now where to find the information. Also, at the get-go, I'll just tell you that there's a lot of confusion around where to find your TFSA room. So if you have a CRA My account, you can always go there and then you will be able to find out how much you personally are able to contribute based on what you have done in the past. Okay, so let's begin. TFSA was introduced in 2009. And in my opinion, aside from allowing Canadians to use their RRSP or part of their RSP to purchase towards the purchase of their first home, it's one of the best thing that the government has done for average working Canadians. And it seemed insignificant at the beginning when the room was only $5,000. But I quickly saw the opportunity as time went on, because even though at the beginning, 5,000, if you're a couple, then two people put in 5,000 together, that's 10,000. So you can quickly see how quickly this can become a significant part of your wealth building strategy. Okay, and that's how, as somebody who is very analytical and strategic in my thinking, that's the first thing that I identified. Okay, so what is actually a TFSA? A tax-free savings is a type of plan, just like an RRSP is a type of plan, or an education fund is a type of plan that you can have. So the TFSA is not an account itself. That's where I find a significant amount of confusion as I talk to people about tax-free. Doesn't matter the age or the education level, that confusion or misconception still comes up. Okay, so the whole premise of the tax-free savings account is to allow Canadians to accumulate money or save without having to pay tax on your earnings. Okay, as you know, in Canada, all our earnings, with very few exceptions, are taxable. And those little annoying T5 or T3 slips, they can make a difference. And the more you accumulate and the more you earn in terms of interest and dividends and capital gains, means that you're losing part of that return to taxation, right? So here comes the TFSA, and for individuals who have already accumulated a net worth, you know, or have a significant cash accumulation, it's a matter of reallocating some of those savings and build up your limit as the limit increases. So we'll move on now to the tax-free limit. So we started in 2009 with 5,000, and the annual limit is now $6,500 for 2023. Okay, the accumulated limit for 2023, that's assuming if you have not ever opened a tax-free, you don't have one now, you've never put money in there. So you have 88,000 sitting in the bank, then you can move the entire $88,000 into a tax-free account. And whatever you earn going forward, you will not be T4 or sorry, T5 on your earnings inside that tax-free. Are we good so far? Everybody's good? Any questions yet? Okay. All right. So with no questions yet, we'll go in, and now I know the questions will start to pop up now when we get into the meat of it. Okay. So where can I open a tax-free savings? Pretty much all the financial institutions, meaning banks, insurance companies, and investment brokerage houses, whether they're full service brokerage or discount brokerage, offer tax-free savings. And yes, you can have multiple tax-free savings, but just be sure that you are tracking your contributions into each. I've had several situations where especially elderly people are vulnerable to this. They may have tax-free savings with an investment firm, and then they go to their bank, or they sell a property or come into some money from somewhere else, and it lands in their bank account, and immediately the enthusiastic advisors or tellers at the bank channel them some of their money into a tax-free. And then that's where you get into a situation where you could be in an over contribution, and the penalties could quickly wipe out all of what you have made, and even put you in a situation where you're behind. So it's actually now costing you money to have a tax-free. So it is very, very important to track and coordinate your contributions into a tax-free savings. Okay. Any questions about that?
Yes, actually, we have one.
Mhm.
I don't exactly know how to phrase it, but it says, does it matter your earnings to put 88K in 2023?
Okay, yeah, that's a great question. TFSA or tax-free savings is not geared to income. So income, the level of income that you earn doesn't affect your or impact your contribution. Excellent question. Your contribution rule. It's based on Canadian residency. Okay. And you can only contribute while you are a resident of Canada. Okay. So for instance, if you're a Canadian citizen, you live in Canada, but say you had migrated here from Jamaica or wherever else, and then you decide to go there and live there and you've been out of the country for a number of years. For instance, I have a very good friend. Her daughter had lived in Bermuda for a number of years because she got a job there. And so during the period she was out of the country, she would not be able to contribute to her TFSA. Now, if you're only out of the country for 6 months and you're maintaining your status as a resident, okay, then that would not impact your contribution rule. But if you are out of the country more than the 180 days, you're engaged in employment or business activity outside of the country, and your status is a resident in that country, then you will not be able to contribute to the tax-free savings while you're out. Now, upon return, you can resume contribution. For instance, I have a client who had moved to Scotland, and then when she came back, she had sold the property she bought while she was there, and she had the money wired into her bank. And immediately the bank advisor went and put all the money to match the tax-free room that was available at the time, but never bothered to question that or to take into account that she was out of the country for 5 of those years. And next thing you know, she is being penalized. Anyway, I knew her, and she was a client of mine also, and I helped her sort it out. But only after she racked up $6,000 in penalties, I was able to appeal to the good graces of CRA on her behalf, and they did wipe out some of the penalties because she's elderly and she didn't know, and the bank didn't ask her. So I occasionally find myself doing that kind of advocacy as well. So it worked out well for her in that situation, but not everybody pays attention, and not everybody has somebody to represent them or speak on their behalf. So they end up just writing a check to CRA, right? So there you go. So keeping track of your room and taking into account special situations like absence from the country is very important. Okay. And again, that's the difference between working with an advisor who would take your situation into account when they're advising, rather than somebody who just, a bank teller who just sees the money and they don't know all the little nuances to take into account. Okay.
Of course. We have another question.
Sure.
By Erica. So if you have a dual citizenship, 6 months here, 6 months abroad, you can't contribute?
As long as you maintain your Canadian residency status, because with your tax, and your tax status is not linked to citizenship. It's where you file your taxes and how much time you spend in or out of the country. There are a few exceptions, which I don't have the list handy here, and I don't believe there is a need to go into that detail right now. But for instance, if you're a diplomat and you're posted outside of the country, there would be exemption for that, right?
Gotcha.
So there are a few exceptions where you're outside of the country working, but that would not be considered as a non-resident. But just like with the snowbirds who go down for 5 months or 5 months and a half, so you come back just before your 6 months, then you're good, because you're still maintaining the number of days residence in the country, and you're filing tax as a resident, so you are still considered a resident.
Okay. Thank you.
You're welcome. All right, so we've talked about the room, we've talked about the the limit, and we've talked about that. So now we'll just go into the applications. So how can you use this tax-free savings to accelerate your wealth accumulation and minimize your taxes, right? So as I've mentioned before, whatever you earn inside of your tax-free, there is no tax slip generated ever, okay? And so that makes it the preferred place to save money. Okay, so I would, if I were a young person starting to accumulate money, what I would do is you're earning, and especially if you have income that's say over 65 or over $70,000, the two accounts that you would want to make sure that you have is a retirement savings and a tax-free savings, and you can do both of those together. That's how I got many young people started when they finish school and get their first job. And when they jump in and start, those clients generally work out to be very successful because they get started early, and if they stick to that strategy, they have quite a bit of leverage in terms of overcoming challenges or having money put away for emergencies and things like that. Now, in terms of application, I would advise against using your tax-free as an emergency account. Okay, and here is why. With the tax-free savings, you are able to put back money that you have withdrawn, but not in the same year. So just like residency or absence from the country can cause issues with the contribution room if you're not tracking your time out of the country, it's the same thing with taking money in and out. You could quickly go into an overcontribution situation if you open a TFSA and you start putting money in, taking money out within the same year. The reinvestment or putting the money back part of the TFSA is supposed to happen the following year. So let's take a practical example. You graduate, you go to the bank, you open your tax-free, and you started allocating a chunk of your salary each pay to your tax-free. Okay? And then you need money to buy a car, and you take money out to go buy a car. You get a big bonus and you put the money back, and then something else happens and you take the money out, or somebody, well, let's say somebody borrowed some money from you, which I not recommended, but it happens. You take money out, the person pay you back, you put it back. You can quickly see, how quickly you can create an overcontribution situation. And by the way, pardon me for not mentioning this before, but for younger folks, this would be important, because even though the upper limit is 88,000, your contribution room starts from 18, from the year you turn 18. Okay, so for the older folks, it's not an issue. But for the younger folks, yes, you need to be aware that your contribution room starts when you turn 18. So even if you turn 18 on December 15, you could still put your 6,500, like for this year. So basically somebody who turned 18 2 years ago would have 3 years of contribution available, right? So that's very important, and I apologize for not mentioning that right off the bat at the beginning. All right. Okay, any questions we need to address before we move on?
I don't see any right now, so yeah.
Oh, okay. All right. So the applications, what can you use your tax-free savings for? Just about anything. And the fact that you can take the money out and then you can put it back, it's just amazing. But the next year, okay, the next year. So let's say you accumulate some money and you want to, co-invest with somebody in a real estate project. You take your money out, you invest it, and in 2 years' time, your money is returned to you with your profits. Then you can return your original withdrawal. And also, if you haven't contributed after you did the withdrawal, then you can also do the extra contribution for those years that you missed. So that's very, very powerful. So anything that you might need future money for, it's a reason to withdraw money. So it's excellent. And of course, there are other applications. For instance, you have children and you want, you have education funds for them, but you also want to save some extra money whereby if they need to go on a trip, for instance, then you don't have to be scrounging around looking for funds to finance their trip. You can accumulate an extra $50 or $100 a month. Different institutions have different limits as to monthly contributions. I find those systematic contribution plan, whether you do it through your bank account or through an advisory firm. I find those over the years, they worked like magic. Because they stay in place until you stop them, and you get into the discipline of doing it, so you don't actually miss the money, and then whatever you don't use for that purpose can always be used for something else. Same thing with having simultaneously an education fund or education plans for your kids, and then simultaneously having a tax-free as a side account to accumulate money for those extras. Works great, because then you've earmarked that money for those purposes, so you don't have to dip into what you were setting aside for your own goals to finance those situations. Right? A great example of this is a dad. I had accumulated money in, and many families, like there's always a shortage of dollars. So you use strategies that work for you in the moment, and as free cash flow becomes available, you can always add and enhance things. And that's how it works. It's because I know of, not many people I know of are able to start setting up things all at once and keep them going. You start with the thing that is most important at the time, and then you build your plan around it. So this dad, when his son finished school, he hadn't used all of his RESP money. So in the final year of university, after he was done, he had 11,000 left in the RESP account. And so I suggested that he move the money into a tax-free and put that son as the beneficiary, so he would know that that's his money from his education plan. Because the RESP, the parent is the owner, the child is the beneficiary. And so technically it was the dad's money, but he earmarked that money for his son's school. He didn't use all of the money, so he transferred what was left. He withdrew it from the RESP and reinvested that into a tax-free and put that particular son, because he had two sons, as the beneficiary. And from the time he did that to last week, the money had actually more than doubled. And so his son got married and he took half of that money and put towards his son's wedding as a gift. And then the balance is there. I'm sure he will give him if he decides to buy a house or do something else with. But that dad is very, very diligent with taking advice and diligent with whatever he started. So it's it works like that. And so he never had to be scrounging around. He never have to take out a loan to help his son. The money was there. So that's one application, our practical application, because that's really what we're into, right? We need to know how to make this thing work for us, right? So another application, I don't know if there are many older folks on the, like me with white hair, on the call, but you all have parents, right? So if you're young and you have parents, this is a conversation that you should have with your parents. And I don't know about you, maybe because I've been in the money business, but I will always discuss things we always discuss with me and my children, Melissa and Jared. We discuss politics, we discuss money, we discuss all kinds of issues. So you should be discussing money with your parents. And so for the parents or for the older folks like myself, there's a strategy that is very beneficial for individuals who have accumulated money in a retirement savings plan, and now they've reached an age or they're at a situation where they can benefit from what we call an exit, our RRSP exit strategy, or an RSP meltdown. So depending on the individual's age and financial situation, you can first convert to a retirement income fund. That's the end stage of your RRSP life, right? Where you convert your registered funds from a contribution phase to a withdrawal phase. So that's called the Registered Retirement Income Fund, or RIF, as they're popularly referred to. I see Rose has a hand up there, but we'll just finish this segment and then we can answer Rose's question. So what we do, if somebody takes early retirement, for instance, they're not yet getting their, they might decide to take their early CPP, but they're not getting their old age security yet, and they may have a work pension. So they may have been a reasonable high earner during their working years or contributing years. So they may have been in the 75 to 100 or more thousand while they were actively working. So you look at what their contribution or accumulation level is in an RRSP, and you said, wow, you know, you might be a good candidate to do an exit strategy. over the next 5 years before you start your old age security popped in, you can start your drawing from your retirement savings. You may not need all the money to live off based on your financial situation. They may have a company pension and they may not have a mortgage. So their income needs might, or have a spouse that covers the bills. So their income needs are low. So that's an excellent time to do what we call the meltdown or exit strategy. By looking at your taxable income and making a determination that you can withdraw X number of dollars before pushing your income into the next higher tax bracket, then that way, and then shift the money into your RRSP. Because like I said before, there's a fight for dollars. There's a competition for dollars. So you may have been able to contribute into your retirement savings to lower your taxes and get a refund, but you may not have been able to reinvest that tax refund because your financial situation required you to put that back into your living expenses, right? So you have to make, like I said before, you always have to make decisions. What serves me best in this situation? And contributing to the retirement savings plan may have served best because it lowered the taxable income and returned part of that tax that you paid through your payroll deduction back to you as a tax refund. So now that I'm not working, I've had this money accumulated, say it's a couple of $100,000. I said, okay, I wasn't able to contribute to my tax-free, but now I'm in the situation where my income is lower. I can take some of that money out and I can reinvest the net amount back into my tax-free. So over a period of, let's say, 5 years, right? Over a period of 5 years, you may have withdrawn, let's say you decided you were gonna take out 5,000 gross per year. So in doing 5,000 gross, the withholding tax would only have been $500. So you would get net of 4,500. You take this 4,500 and then you put it into your tax-free. So over the course of 5 years, you can see how quickly, right? You would be building up money in your tax-free that now you can use it if you need a lump sum of money. Yeah. And every single person that I have done this for or helped them do, they absolutely love it. I had a lady call me a couple of days ago and she was asking, oh, I didn't withdraw any money from my RIF, but I got a statement. I says, you remember we set up the automatic transfer of, so you get your RIF still, but the money goes into your tax-free. Did you see your tax-free statement, how it's building up? And she's been doing this now for maybe 5 years or 6 years. And she says, oh, I went into a little more explanation. And then finally she says, oh my goodness, Beverly, I finally understand it. She's been doing it for the 6 years. She did it, but she really didn't get the full implication of the benefit of what we was doing. And she was so happy because now she saw that there is a big sum of money if she need to do anything, a transaction, buy a new vehicle, whatever. That money is there. If she passes on, then now that money goes to her son, completely tax-free. So that's another application which I have next. So we discussed the different uses. You know, you can use as supplementary toward deposit on a down payment as a house to purchase investment property. You can use it to as an exit strategy from your registered retirement savings plans or RIFs. And so we've discussed all those benefits. Now, the next benefit is the estate planning tool. And estate planning tool, it's very, very beneficial. Nobody knows when they're gonna die, but we know that everybody dies at some point, right? So a lawyer back in the early 2000s made this statement, who was an estate lawyer, made this statement at a function I was in attendance at. And it stuck with me, and I've just adopted it. He says, nobody should have an unplanned death, right? Because we know everybody's gonna die. So one of the things that I do, I always take into consideration the consequences of the account if the owner of the account passes on. Now, the tax-free present an excellent opportunity to not pay tax or to defer tax, legally avoid tax on the money you have accumulated in there, because by naming a beneficiary. That's the one thing you can do with a tax-free savings that you cannot do with a regular non-registered investment account. You cannot put a beneficiary if it's, unless that account is with an insurance company, sorry, that. So if you have a regular account in the bank or with a mutual fund company or an investment broker, it's not an RRSP, it's not a tax-free, it's just a regular investment account. That account is taxable, and you cannot name a beneficiary on that type of account. If it is with an insurance company, you can name a beneficiary, but it's still a taxable account in terms of the investment earnings. Okay, so it's a great way to make sure that the money, that potential amount of money that is going to, that would end up in your estate, is reduced. Okay, so for couples, for married people or people who are couples, whether you're common law or married, it is a great planning tool, because for spouses, your tax-free goes over to the spouse. If you have the spouse named as beneficiary, the value of your account goes to your spouse tax-free. And here's the bigger kicker: it doesn't affect the receiving spouse's tax-free room, right? That only happens for spouses, right? So let's say, for instance, the room is $88,000 as of this year. You've been diligently maximizing your tax-free savings. You've put your 88,000, and since 2009 till now, the value of your account is 150,000. So you have two spouses; they've each maxed their tax-free. So they invest in the exact same thing. So their total combined tax-free accounts value is now 300,000. That's a significant amount of money, right? So those are monies now that are not subject to income tax, like their earnings are not subject to income tax, and those accounts will move over to the surviving spouse tax-free. Okay. If you choose to put a child instead of a spouse on your tax-free, then the proceeds go to your child or children tax-free, but they are not able to roll those money over into their tax-free without affecting their tax-free room. So in other words, they can move money from an inheritance through a tax-free into their tax-free, but they would need to be sure to have the tax-free room available to receive the proceeds, so you don't go into an over-contributing situation. Okay, so now we can answer a couple of questions.
All right. So, I mean, before Rose, I know Rose's hand has been up, but iPhone, there's an individual named iPhone, and they asked, just to clarify, it's 80,000 limit, or is 80,000 the limit across TFSA accounts in general?
Yeah, so it's total accumulated contribution, not value, because they don't take into account the gains that you have made or your earnings, right? So contribution into the tax-free for this year, the total 88,000, right? Across all accounts. So if you have one in your bank and one with an investment firm and one with your friend who is doing investment, so everything, your total contribution cannot exceed the 88. And CRA does track it, and you can print out your contribution history if you have a My account.
Okay.
All right.
Perfect. So now Rose, we're going to unmute Rose so that they can ask their question themselves.
Okay.
Hi, good morning, and thank you all. My question for the tax-free savings account, once you start investment, is there any limit on the gains you can have from that investment?
Oh, your question is so amazing, because actually I had planned to talk about abusive practices in tax-free. That will get the CRA people on your case. And what are abusive practices? You know what they're targeting now? Day traders. Day trading in your tax-free savings would be considered an abusive practice.
Oh.
So if you're racking up a lot of gains in your tax-free, then you're going to catch the attention of the CRA. So apart from certain specified what they consider abusive practices, which the day trading is one of the more common ones, then there are some other ones which mostly high net worth and highly sophisticated people use. For instance, they could transfer shares of a company and undervalue the shares, and then once the shares get into the tax-free, then all of a sudden it's worth a lot more. And there are a number of court cases and rulings on those. So just a normal tax-free you have at a discount brokerage, you buy a couple of banks and or insurance company stocks or a few technology stocks, and if they, you happen to buy them at a low price and then they just boom, take off, then you made an investment decision. There's no speculation there apart from you speculated on whether you were going to make a lot of money on the tax-free on the investment or not. So that wouldn't be considered abusive. So yeah, so if you were lucky enough to buy you know, Amazon or any of those companies, when the share tanked and then you double or triple your investment, you're good. But yeah, or if you invest in mutual funds and you know, you just keep plodding along and your money double and triple because you made good choices, you're good. So their CRA just target those questionable activities, because remember, the companies have to report to CRA, and like I said, you can download your history. So they know what's happening in every single TFSA. So the ones that will catch their attention are the ones that have unusual activities. All right. Did I answer your question, Rose? Oh, she didn't answer. She probably unmuted again. All right.
Yes,
Well,
you, sorry. Yes, you did. Thank you very much.
you're very welcome.
I'm not in the stock market in that sense. It's more just a steady investment with compound interest, and sometimes the returns are good. And so I
Right.
just wondered whether there's a limit. So thank
No.
you very much. You did answer my question.
Very good. Thank you.
Thank
All
you.
right. Are there any more questions there, Lincoln?
I don't see any yet, but maybe if we give them a minute or two.
Okay.
No, in case people are typing. That's what I'm thinking.
Right. All right. So we'll go on to if we don't have any more questions about the estate application, then I can go into the investment options, because like I was saying at the beginning, the most confusion that I've come across with the tax-free is really what they can put in their tax-free. And what is a tax-free, like, because a tax-free is not an investment. It's like I said at the beginning, it's a type of account. So when you have a tax-free, what you put inside that tax-free is going to be based on the purpose of the account, right? So, and that's where maybe multiple accounts may make sense, because you may have a tax-free that would be to supplement your child's education. So you're not going to invest that money the same way as an account that you may want to do supplement your retirement income if you're a younger person. Because if you're younger, then you have a longer time horizon. So you might be a little more aggressive depending on your risk profile when in your younger years. So yeah, so and depending again on your capacity for risk, then you know, you might have a conservative account that you might want to fall back on. If you're unemployed, you need to draw money from to pay your bills, things like that. So you might want to. Or if you're saving towards a house and your goal is a 5-year goal, then you would be more conservative in your choice of investment for your tax-free savings. And but if you have a longer time horizon and you have extra money set aside for emergencies and stuff like that, then you would maybe want to take a little bit more risk, so you have a potentially higher return on your investment. For instance, the example I shared about my client that reinvested the funds, the leftover funds for his son's RESP, then it was in a, you know, like a moderate mutual fund account, and but he did well. He averaged, you know, almost 9% annual compound rate of return since the money was moved into the tax-free. So that's a very, very decent return. And it served the purpose, right? If you're going to use the money in 2 years, you might want to opt for just a high interest savings account or a GIC, which a guaranteed investment certificate, which you can use those instruments as well into your tax-free. And if you have enough money in your tax-free, that makes sense to diversify and hold different types of investments, then that is also possible just within the one account. So if you have you put 88,000, you can break it down and put a percentage in different risk levels, and depend on where you hold your account and the type of account that you have set up. Okay. Any questions?
Yes, we have a question from Ali. What is the difference between SEG and a GIC, and which one is better?
Oh, SEG, which would be like seg funds? I'm not sure.
Ali, is that what you're referring to? Yeah.
Oh, okay. Now a GIC, as the term implies, it's guaranteed investment certificate. So when you invest in a GIC, your principal is guaranteed, and the rate of return in most cases is guaranteed as well. So you will not earn more, you will not earn less, and your principal will not fluctuate. So that is the main, it's a huge difference. Okay, so there's no fluctuation on your capital, but you can only earn what's promised. With a seg fund, a segregated fund is an investment in an insurance company's, it's like a mutual fund investment in an insurance company. So they call it segregated funds because those funds are kept separate from the general funds of the company. So that's why they're called segregated, because they're separate. And that's why there are guarantees on return. So for instance, if the insurance company goes down, goes under, or get into financial difficulty, it would not affect your segregated fund investments because those are held separately. Okay, so now your segregated fund, you have many different investment options within a segregated fund. You can invest in an equity fund, a dividend fund, which a dividend fund is an equity fund, but it is investing in firms that pay dividends, right? So the value of your investment does fluctuate with the investment market, but the segregated fund contract provides certain guarantees. The minimum guarantee that is provided for a death benefit or a maturity benefit based on the prescribed by the government, and that's what makes them different from mutual funds, is 75% of your money. So if somebody invests 100,000 in, let's say, in a segregated fund, and it's just so happened that shortly after they invest the 100,000, the market went down 25%. So now you're at 75,000. And let's say you poor unfortunate soul, or the beneficiaries would be the poor unfortunate soul at this point, happen to die shortly after that, before the investment recovered. then the beneficiaries would be guaranteed minimum that 75,000. That's called the maturity, the death benefit, guaranteed death benefit. And of course, there are some of the companies, some of the insurance companies do offer 100% death benefit guarantee plus inflation. Some offer plus inflation. At least there's one I know that offer plus inflation. But you have to pay a small extra fee for that extra guarantee. But in some cases, it's worth it. If that peace of mind. I never really paid too much emphasis on the maturity guarantee for seg funds, to be honest, simply because some of the maturity guarantees are so far out. And if you're only going to promise me 75% of my money back after 20 years, personally, I'm speaking personally, I really don't see the benefit, that big a benefit. There might be other investments that can do better for you. But it's there. But the death benefit certainly is a big one because nobody knows when they're going to die. And especially for spouses, you want to protect, you know, your money for each other. That might be something that is of a concern to you. And then definitely, yeah. So Stephanie, I hope I answered your question. All right.
Yes, Ali says thank you.
Oh, Ali, that was Ali. Sorry.
All right.
Okay, great. So do we have any more questions?
Seeing any questions right now? If there is one, I will definitely let you know.
Okay. All right. So we can continue and perhaps give a little bit more information. And we go till 11:30, do we? Or what time are we going to? I just want to be cognizant of the time.
Yeah, 11:30 is when we're meeting.
Oh, okay. So we have a lot more time for questions because I find that Q&A I find are most beneficial because you're answering to specific situations and everybody learns from it. So feel free to put your answers in the chat, or you can raise your hand and I can answer and ask your questions directly and I can answer. All right, so we can talk a little bit more then about investment options. And now that interest rates have okay, so there is one question. I'll answer that. In my opinion, I feel that working with an advisor, it's always more beneficial because studies show that the accumulated wealth for an individual who works with an advisor is in the multiples over those who try to do it themselves. And I can tell you that you can work with an advisor. I have nothing against a bank advisor, but my experience is that a bank advisor, one, they move them around often. And when I get clients transferred over from the bank to come to me, that's been their number one issue, is that they may be assigned somebody who they like and is very knowledgeable, but the people who are smart, they get moved around a lot. They get promoted and transferred. So you may have somebody for 6 months and the next time you go into the bank, it's somebody else. Okay, so that's one. And then the second reason, which probably for me is the most important reason, the banks are huge bureaucracies. So they pretty much have a limit. There's a big limit as to what an advisor can say and the kind of advice that you can give. So a lot of these information are on the taxes, practical applications, stuff like that, that I'm telling you. I have developed the skills and the knowledge based on my own personality and my experience, and I can share it with people. When I sit with somebody across the table or the desk, if they come to my office or if we're meeting at their home, I can get into like their family situation and I get a greater sense of what the person's life is like, what their goals are. There's limitations in the bank. First of all, they're usually so rushed. And I just remember recently I went down to the bank I deal with just near me, and there were so many people. I just wanted to ask one question, but the teller couldn't answer my question. I had to sit there and wait for somebody to come out and answer and then I had to wait so long because there were quite a few people who needed to speak with an advisor. And the question that I had to ask, it only took like not even 2 minutes, but I had to sit there and wait, you know, like maybe like for half an hour just to get that one question. And then I knew she didn't have more time. I didn't need to because I'm an advisor myself, so I just wanted to ask a specific question to my account at the bank. Okay, so it's always better to work with an advisor. You're going to get better quality advice and more practical advice, right? So that's my opinion. Thank you.
Thank you. For those that can't see the chat, for some reason, the question that was asked was by Middle, and it was, can I ask my bank about these investment options or should I seek an advisor? So that was Beverly's answer to that question.
Okay, that's good. Yes.
We have another question here by Christine Paris. My daughter turning 18 in July has $4,000 in regular savings, heading to university in the fall. I wanted her to open up a TFSA, but not sure what she needs the funds for.
Okay, so your daughter is going to be going to college and she may need extra money during the course of that time, but also not having the funds just sit in a savings account, earning practically nothing, right? And so by opening the TFSA, that would be a great start for her. She may go to college and may not use the account. So at least it would be earning something while it's there. And my feeling, and I always say to client, if you make $10 in your pocket is better than $10 in the bank's pocket, because you are actually lending them the money, they're putting it to work and they're making profits off it. So why not at least get something on it while it's there? And then if she moves it into a TFSA after her birthday, then whatever she earns, she wouldn't get a T5 if she puts it in a GIC type. And she can go, like, interest rates are a little bit higher now. So she could put it in a short term, you know, under a year, because generally they're not cashable. Or if it's a cashable GIC, then she could do it for a year. And if she needs the money, she could still cash it, but they'll just recalculate the interest. Okay. I saw another question.
Yes, there's another question by Juliet. How often can you make these tax-free savings transfers, or what is allowed without being taxed?
Okay, so let me go back and clarify that with the tax-free savings, you do not get to deduct your contribution from your income tax. So you don't get a tax receipt to deduct from your income. The earnings on your tax-free is free, right? So you can transfer money into your tax-free up to your maximum limit, and you can withdraw money out of your tax-free up till the money you have in the tax-free. However, I advise not to use the tax-free as an emergency account, because the whole point of tax-free is so that you can earn money and not pay taxes on it. So if you're just doing an in and out thing, it's not going to be beneficial. And then on top of that, you may end up paying penalties because you might be transferring, you might end up in an over contribution situation if you transfer the money back into your tax-free in the same year. Does that make sense? Okay. So the best way to utilize your tax-free savings is to have a tax-free and invest the money into something that you're earning. The whole point is to earn money and not pay taxes. Yeah. And of course, it's more beneficial the longer the time between now and the time you're going to need the money or you plan on using the money is the more options you have in terms of investing, as I said before. If you are going to need the money a year from now, do not go and buy Bitcoin. Well, I don't know if you can do Bitcoin in your tax-free, but do not go and buy a speculative investment. If you're going to need the money a year from now, regardless of what you have invested, that's across the board for investment. If you want to be sure you have the money there for the purpose that you intend, and you need the money a year from now, 2 years from now, the time horizon is a huge consideration into what you actually invest in. But if you're a risk-averse person, that means that you don't like risk, you don't like fluctuation in your capital, in the money you actually invest, then you can invest in guaranteed interest investment that does not expose your principal to market fluctuation, right? And that's where somebody like myself, who is also a GIC broker, can come in, because we deal with many different financial institutions who are CDIC insured. That means that you're covered under the deposit insurance, and you can invest in whoever is paying the best interest rate, and if you like the institution, right? So so there are different banks, well, not Schedule A banks like the Big Five. There are other Schedule B banks. They're also insured under the CDIC. They don't have retail branches, but they lend money for mortgages and they take deposits. And that's where they get the money to lend, right? So they take in deposits for mortgages and for GICs, sorry, and they loan money out for mortgages, but they're very much covered under the deposit insurance. Okay, so everything really that you do, your risk tolerance, your personal outlook on life and on investing, and the purpose and your time horizon, all those things make a significant contribution into your choice of actual investment. Okay.
Oh,
Were there any more?
thank you. Yes, we have one more.
Okay.
Tamara O. She says, I've heard of some only using the bank for an emergency savings account or not at all because they put it into other investments such as TFSAs. What are your thoughts on this?
Okay, could you read the question again for me?
For sure. I've heard of some only using the bank. I've heard of some people only using the bank for an emergency savings account or not at all because they put it into other investments such as TFSAs. What are your thoughts on this?
Oh, okay. So the question is, I get what they're saying, that some people are not using the banks for their emergency savings, and that can happen. Now, I always recommend keeping at least, a month's bill expenses in your account at the bank. Unless you have a discount brokerage with the same bank and you can move money yourself right through, because it's easy. Now, it's all has to do with ease of access, right? Because depending on what you do for a living and so forth, or things come up. Your car might need repair, you don't want to do a credit card, or if you don't have credit card, then you're needing money. And sometimes it does take a bit of time. Even 3 days might cause a situation, because with most mutual funds or non-bank investment, it does take a couple of days once you redeem the investment for the money to land in your account. So having a month or two of expenses in a bank, whether it's going to be in a high interest savings, like I said, I do not recommend you use your TFSA as an emergency fund, because the whole point of the TFSA is to earn money tax-free. And if you're just holding it as an emergency fund, then you're going to be doing the in and out transactions, right? Depending on what's come up for you or what's likely to come up. So have a couple of, have some leverage, some wiggle room by keeping some money in a high interest savings. If you don't want to keep it in your checking account, I don't recommend that you keep it in your checking account unless you're getting some benefit from it. And then you can do your tax-free, whether it's with the bank mutual fund or a bank GIC account or whatever, but you're going to invest it so that you're earning, right? Now you can get, like 4.5%, 5% on a GIC. So even if you're not wanting to take risk, if you're going to get 0.5% leaving the money in your savings, why would you leave it there when you can invest in something and get that? Even though really at 5%, inflation is still eating up a lot of that money, but at the same time, it's still a significant amount more than what you would earn in a shorter term. Yeah, because in my situation, I have access to even some of the bank's products on our mutual platform, because the banks own some. We deal with bank mutual funds and bank investment accounts. So you know, so they're available, but it might take 1 or 2 days, or it may take 2 or extra days to get to the money.
Yeah.
So you allocate your funds according to your personal financial and family situation. I hope I answered that question. I can expand on it if you need to. Yeah.
That's where it says thank you.
Yeah, you're welcome.
Amazing. Does anyone else have any other questions?
No questions? Okay. All right, so we can do a little recap. We have a couple of minutes. So to recap, you need to be 18 or older to open a tax-free savings. And you can only invest the amount since age 18 if you're for the years that you're absent from Canada, in that you're not considered a Canadian resident for tax purposes, you cannot contribute for those years. Okay, the contribution room for 2023 is $6,500, and the total room since the inception of tax-free is $88,000. So how much you can invest today would be the 88,000 minus what you've already contributed. Okay, you can make withdrawals, you can return the investment, the withdrawal amount, but not until the following year. Right? So for instance, if I had $50,000 in my tax-free today, I could withdraw the entire 50,000. I could leave $1 in the, or $1,000 in the account just to keep it open, so I can take out $49,000. Right? I could return the 49,000 and not affect my TFSA room, but I cannot return it in the same year I took it out. I have to wait until the following year, right? I could return enough money up to the total maximum room, right? Because if I have 49,000, okay, so let me do this as a practical example. If the value of my account is 50,000, but out of that 50,000, I've contributed 45,000. So that means 5,000 would be profit, right? The maximum limit for 2023 is 88,000. So I could take out my 45,000 that I have contributed, and let's say I was going to do something, so I took the money out, and that transaction or whatever I was going to didn't pan out, so I have the money still and I want to return it. To return the full 45,000 that I took out, I have to wait till next year. However, because I had not used up my full limit, I could actually return, let me see now, 50, that's 38,000, 43,000 I could put back right away, because that's not gonna put me in an over contribution situation, right? Because I still have room, but the rest of the money I have to wait till next year to put back. Or you could wait till the next year and you're put back the whole thing, and there's no convolution of how much you contribute or not contribute, right? And practically, actually, it might actually make sense to wait till the next year if, depending on what you invest in, because if you wait till the next year, then you can put the whole sum back and it would not affect your available room, because you never know if you inherit money, you come into a lump sum and you have that room, you can always stick a big sum of money in, right? So if you withdraw from your TFSA and you have available room, it may not even make sense for you to use up your previous unused room. Just wait till the following year and you put the whole sum back, then you still have your unused room intact. Does that make sense, or does anybody want me to explain more? I just came up with this idea just now, so I have to write it down for myself.
Nadine wants you to explain. We do have questions, so I don't know if you want to go to the questions or if you want to expand on this first.
Okay, let me do the questions and then we'll expand on this a little more. Nadine can message me and I can explain to her after the session.
Sounds good. So we have three. The first one is Elaine. She says, my son has a good job, so stability, and I've been encouraging him to move over 25K into a TFSA or an RRSP, but he won't budget. How can I explain it to him better?
Send him to me. No, that sometimes works, but if you can explain to him the concept of putting his money to work. But if he has 25 grand saved up, he really should be talking with an advisor and sort out his goals and because the bank, let me tell you, we're not here to do the banks a favor. They are rich. They're making billions of dollars per quarter, not per year, per quarter. So why would you, an average person, want to leave your money sitting in an account not earning anything? It does not make any sense. Put your money to work and put it to work in a tax efficient way. So the government's not getting if he's in a good job, he's already probably paying high taxes. I always say that the government makes all the money I invest in my kids, the government is reaping the benefits. They're doing well. I'm not getting anything from it. The government is. Right? So why would you've made your contribution in another way, or you're paying enough taxes? And this is the mantle of my financial advice, is that whatever avenue is available for you to legally reduce your taxes, it's up to you. A good mentor, he was in his 80s, he passed away. And something I learned from attending a workshop that he gave in my very early days, he said the only money you get to spend is what the government allows you to keep. Okay, let me repeat that. The only money you have to spend is what the government allows you to keep. So if they're already taking 30% of your money off the top, and I mean, I saw a T4 for a young lady that's a client of mine, and she earned a pretty good salary. And when I saw what she lost and contributed to the tax system and what she ended up with, I'm like, oh my God, that's why it is really so hard for average working people to get ahead. If you're losing 40% off the top before you actually see the money, right? How are you going to get ahead? So you get ahead by taking advantage of the legal avenues that is there. But guess what? They're there in the tax code. And when people come to me complaining, I said, the one thing I know for sure, there is no discrimination in the tax code. It applies level to everybody. Some take advantage and some don't. But guess what? They are not going to come and beg you to take advantage of it. It's up to you. And the people who I've worked with over the 35 odd years that I've been in doing this are the ones who are diligent and disciplined in their approach to tax planning and consistency in saving and investing. There you go.
Thank you so much. We have a few more questions. We're running out of time now a little bit. So what we're gonna do is we're gonna go to Sankofa. If we're able to drop your email in the chat, then can people reach out to you via email to ask more questions or?
Okay, yeah, absolutely. I'll give you my work email. I'll put it in the chat.
Sounds good. So I know Ali had a few questions. And Nadine wants further explanation. So if you guys can reach out to Beverly via her email, I think that would be very appreciated.
Okay, so let me just make it quick since you know it's but it's good to hear all of this vibration. But question is, what's your thoughts around, say, using line of credit, using credit to do TFSA? Is there a calculation to be done, and will it work out in the long run if you're going to make money in your TFSA tax free?
Oh, absolutely. And the best time to have done that was like 5 or 10 years ago when interest rate was almost zero. But it even based on today's rates, it can still work, but you have to be careful.
Okay, thank you.
Quick answer.
Lovely. All right, so I think we can start wrapping up now.
Okay.
So we're going to go into a few upcoming events that we have at the BBPA. Firstly, I just want to really thank you, Beverly, for everything you've done today. It's been an incredible presentation. So thank you so much. I know a lot of people in here learned a lot of things, myself included. So I really want to thank you for that. All right.
You're so welcome.
So we have a few events coming up for the BBPA. One being the HR Management with Tanya Sinclair, Tuesday, March 14th at 2 p.m. All right. The next one being the Black Women in Aviation with a panel of incredible women of color. And that's going to be March 15th, Wednesday at 12 p.m. Eastern Standard Time. Lastly, Ivor Christopher, CPA, CG Chair, Pan-African Credit Union Initiative. That's going to be hosted by Moi Fung on Saturday, March 18th at 10 a.m. Eastern Standard Time. Those are the events we will have coming up. Again, if you have any more questions, you can reach out to Beverly Allen. Her email is in the chat, so screenshot it if you haven't written it down already. If you want to find this workshop or find the last few workshops, feel free to subscribe to the BBPA YouTube channel to have access and be up to date. All right, thank you guys so much for taking this time to be a part of this incredible workshop hosted by Beverly Allen, and have a great rest of your weekend until next time.
Awesome, thank you. You're welcome, everyone. Looking forward to hearing from you. Thank you, Lincoln.
Community Spaces, the financial literacy program that speaks and reaches the community. Are we going to be in a better place, or are we going to be still, quote unquote, behind the 8 ball?
Because of the historical disadvantage that our community has, we most times do not have financial role models. Without that, economically and financially speaking, we'll always be at the bottom.
keep proper books and record, because the data drives the strategy and the strategy drives the profits.
COVID-19 sort of removed a veil. It's really exposed the structural barriers that our communities face.
These last 2 years, where there's been a heightened emphasis on the well-being of Black people, has influenced the influx of funds and opportunities. The time is now. How long is that window going to be open?
We'll see you next week. And don't forget to tell a friend to join us here on Community Space